What if the digital dollars in your wallet came with terms and conditions written by the US government? What if your stablecoins could be frozen, delisted, or simply outlawed with a Senate vote? This isn't science fiction. It's the legislative reality forming in Washington right now. And today, we break down the bills that could either legitimize crypto or bury it. Imagine a world where the digital dollar is no longer just an experiment, where stablecoins are not only regulated, but issued by Wall Street and monitored by Capitol Hill. That world is arriving faster than most realize. And today, we dive deep into the bills that could make or break the future of stablecoins in America. Over the past 24 hours, US lawmakers have advanced two significant pieces of legislation: the Genius Act in the Senate and the Stable Act in the House. These bills are aimed squarely at stablecoins. What was once considered a decentralized innovation is now facing intense scrutiny from Washington. This push isn't random. With stablecoins like USDT and USDC processing billions in daily transactions, both the Treasury and the Federal Reserve are calling for tighter oversight. And fast. So, what's actually inside these bills? Both the Genius and Stable Acts define payment stablecoins as digital assets pegged to the US dollar, redeemable on demand. And the proposed requirements are strict. Issuers would need to back every token with one-to-one reserves, including cash, US Treasuries under 90 days, or insured deposits. Transparency is front and center. The legislation demands monthly audits by independent firms and full public disclosures about reserve composition. It also bans rehypothecation, meaning issuers can't use customer funds to chase yield. Importantly, these bills outline who gets to issue stablecoins. The options: apply for a new federal payment charter or work within existing state-level frameworks. It's a shift toward legitimacy, but also toward control. Why does this matter? Because stablecoins are quickly becoming the plumbing of the digital economy. They serve as gateways to DeFi, NFT marketplaces, gaming economies, remittances, even traditional fintech rails. Regulation could unlock enormous growth. And here's a critical detail. The bills clarify that payment stablecoins are not securities. That alone could remove a major overhang from the SEC, giving the market much-needed regulatory clarity. Circle, the company behind USDC, has already responded positively. Its IPO, which was previously delayed, is now moving forward again, with analysts valuing the company at over $7 billion. Meanwhile, PayPal's PYUSD is making headlines for prioritizing transparency and compliance from day one. But this regulation doesn't just impact companies, it reshapes capital markets too. Today, stablecoin issuers collectively hold more than $166 billion in short-term US treasuries. That makes them major players in the government debt market. Any regulatory adjustment could ripple through treasury liquidity. Tether, the issuer of USDT, may be the most affected. Despite its size, it remains under scrutiny for its reserve disclosures. By contrast, US-based issuers like Circle could gain market share simply by adhering to these new frameworks. DeFi is also being recalibrated. Protocols like MakerDAO and Aave are likely to shift toward assets that are explicitly compliant. That means more lending powered by USDC and perhaps less reliance on algorithmic stablecoins. But this story isn't only about finance, it's political. The Genius and Stable Acts have rare bipartisan momentum. Republican figures like Senators Bill Hagerty and Cynthia Lummis are backing innovation. Meanwhile, Democrats such as Gillibrand and Waters emphasize consumer protection. Of course, there's skepticism. Some voices, particularly those aligned with President Trump, argue that these frameworks open the door to federal overreach. And there are questions about conflicts of interest, especially as it's been reported that Trump himself holds crypto assets. Regardless, the legislative path is clear. At least one of these bills could pass by Q4 2025. So, what should investors and builders be paying attention to? First, the composition of stablecoin reserves. If interest rates fall, the returns on those Treasury holdings shrink. That hits the bottom line for issuers like Circle. Second, liquidity in decentralized finance will likely shift toward more compliant, KYC-driven protocols. We may see more walled gardens emerge in DeFi, safer but less open. Third, enforcement is no joke. Issuers that fail to meet standards could face daily fines of $100,000. That's a real risk for smaller players. And finally, international implications. Foreign stablecoin projects may exit the US or geofence access, repeating what we've already seen with Binance. What we're witnessing is a complete transformation in how digital dollars wrap up. The stablecoin battleground is no longer just a debate on crypto Twitter. It's now a legal, regulatory, and geopolitical force that could redefine how digital dollars move through the global economy. Whether you're a long-term holder, a DeFi builder, or a curious observer, keep your eyes on Washington. Because what happens in the next 90 days might just dictate how you move money in the next 10 years. Subscribe to Crypto Alpha Edge for more deep dives. Next up, DeFi under pressure. Who's next on the regulatory radar?